How do international transactions complicate business audits for global companies? Imagine trying to piece together a puzzle where some pieces are in different languages, some are in foreign currencies, and others follow rules you might not know. That's what auditing a business with international transactions can feel like. When a company operates across borders, it handles money, goods, and services in multiple countries. This means it must follow different tax laws, accounting standards, and reporting rules in each place. For Asian American-owned businesses that work with overseas partners or suppliers, this adds layers of complexity to the audit process. One big challenge is understanding and complying with different regulations. Every country has its own rules about what expenses can be deducted, how income should be reported, and what records are needed. For example, a business might deduct certain expenses in the United States but not in another country. During an audit, auditors need to verify that the company is following each country's rules. If they find discrepancies, it can lead to penalties or fines. Small and medium-sized businesses often lack the large legal or accounting teams needed to manage these differences smoothly. Currency exchange is another tricky part. When a company makes a sale or pays a supplier in a foreign currency, the value of that currency can fluctuate. Auditors need to check that the company recorded these transactions correctly using the right exchange rates. If the company doesn't track currency changes properly, it can cause errors in the financial statements. These mistakes can lead to questions from auditors and possibly penalties if the errors are significant. Intercompany transactions also add to the complexity. When different parts of the same company in various countries buy or sell from each other, these transactions must be recorded accurately and in line with local laws. If not, it can cause confusion during the audit. Transfer pricing, which is how companies set prices for goods or services sold between their own divisions, can be challenged by tax authorities if prices seem too high or too low. This can trigger audits, penalties, or disputes that take time and resources to resolve. Cultural and language differences can also slow down the audit process. Working with overseas partners or auditors means overcoming language barriers and understanding different business practices. Miscommunications can lead to mistakes or delays in providing the right documents. This makes it even more important for Asian American-owned businesses to keep clear records and communicate effectively. Cybersecurity and fraud risks are higher with international transactions. Auditors need to verify that the company has strong security measures to protect its financial data, especially when dealing with international banks or payment systems. Any signs of fraud or weak security can raise red flags during an audit and cause further investigation. To manage these challenges, businesses should keep detailed, accurate records of all international transactions. Staying updated on international tax laws and compliance rules is essential. Using technology tools that automate currency conversions, monitor compliance, and track payments can make audits easier. Planning ahead and working with auditors who understand cross-border issues can help prevent problems and make the audit process smoother. Being proactive with international transaction management ensures that global business operations don't turn into obstacles during audits.